former Federal Reserve Vice Chair Alan Blinder, now professor of economics at Princeton, and joins us now. The question is if they were late, and it's hard to know that, Alan, should they go more now? And I think the read in today's inflation report is there's still pockets of sticky inflation. I'm not sure it suggests that they should do a double or an emergency cut or anything like that, does it?
No, I don't think so. I think an emergency cut at this, first of all, it's not warranted by the data. It's not like the economy's in a nosedive or anything. It's still in quite good shape. Secondly, it would suggest panic at the Federal Reserve. They're not panicky. I don't know why they would want to give a false signal that we're panicky. I do think they're a little bit late, but I would emphasize a little bit late. You know, if I had my druthers, which of course I don't, they'd have cut 25 basis points in the July meeting. They didn't do that. So they owe us that, and they're going to deliver it pretty soon, I think. Now, there is the possibility that the economy gets a lot worse between now and September. I don't think so. They don't think so, but maybe it could happen, in which case they should deliver more. But if that's not the case, which is the forecast of most people, 25 basis points in September, with an indication that there's more to come, I should add that, that's important, would do fine.
September 6th is shaping up to be a key day because that's the August employment report, and it happens before the September Fed meeting. So what's your best guess as to whether they'll go 25 or 50 in September?
My best guess now is 25. If that employment report looks lousy, which is not what we think, but it could happen, then maybe they do 50. But, you know, basing on what the market thinks and what I think is likely to come out of the Labor Department, then 25.
What indications do you have about how fast the economy is turning here or softening, and whether we're going into perhaps a deeper slump than the Fed or the consensus expects?
Well, we watch the labor market, of course. That's just what you've been asking me about, Sarah, which includes weekly claims and things like that, which are not sending out distress signals. And secondarily, we watch, everybody watches the consumer. Steve mentioned retail sales. That's a good part of consumer spending. And if the consumer starts losing steam, if consumer spending starts losing steam, the economy is going to lose steam right behind it. So far, not. Consumers are simmering down a little bit from the blistering pace that we've become accustomed to since the hyper recovery from the depths of the pandemic recession. So we're not moving at that pace, but we're still moving. Consumer spending is still moving up at a pretty good pace.
Do you worry about any of the parts of the inflation basket that are sticky? Owner's equivalent rent, we keep talking about that shelter. Yeah. People think it's lagging. The auto insurance rates, for instance, energy. I mean, it was flat this month, but we're seeing oil prices move up.
The energy has been very good. I mean, there are ups and downs for sure, and there will be more ups and downs, and who in the world knows what's going to happen in the Ukraine-Russia theater of war, not to mention the Middle East. So there are unpredictable hazards there. Auto insurance, you know, that's getting a lot of attention. If you compare that to owner-occupied rent, it's trivial. I mean, the owner-occupied rent is a big hunk of the price index. It's a big piece of most people's budgets, not their auto insurance. And so that bears watching. And as Steve said, most of us economists have been expecting the inflation rate of that particular component to trail down a bit more than it has. The graphic you put up shows that it has trailed down, but very slowly.